If you're applying for a home loan, you will hear the term debt-to-income ratio or DTI. But what is your debt-to-income ratio and why does it matter so much if you're getting a home loan? In this video, I'll explain what debt-to-income ratio is and why we care about it so much. Your debt-to-income ratio is your monthly debt payments divided by your gross monthly income. This number is one way lenders measure your ability to manage the monthly payments to repay the money that you plan to borrow. To calculate your debt-to-income ratio, you'll add up all the monthly debts and divide them by your gross monthly income. Your gross monthly income is generally the amount that you have earned before taxes and other deductions are taken out. For example, if you pay $1,500 a month for your mortgage and another $100 a month for an auto loan and $400 a month for the rest of your debts, your monthly debt payments are $2,000 a month. If your gross income is $6,000, then your debt-to-income ratio is 33%. That means $2,000 in debt is 33% of the $6,000 of gross monthly income. Evidence from studies from mortgage loans suggests that borrowers with higher debt-to-income ratios are more likely to get in trouble making their monthly payments. The debt-to-income ratio is important because it tells the lender how much money you have left over to pay your monthly expenses like food and utilities. A good target DTI depends on your financial strategy. The requirement to qualify for a home loan will vary by the lender and type of mortgage program. Ideally though, you'll want to keep your DTIs as low as possible regardless of the lender's limits. Paying down debt will help improve your credit score, and a higher credit score and lower DTI will help get you access to better mortgage programs. Although your DTI ratio is important when getting a mortgage, the number doesn't tell the whole story about what you can afford. DTIs don't take into account expenses like food, health insurance, utilities, gasoline, entertainment, and they count the income before taxes, not your actual take-home. You'll want to budget beyond what your DTI labels as affordable and consider expenses compared to your actual take-home income. The higher your debt-to-income ratio, the more likely you are to struggle with qualifying for a mortgage and making your monthly mortgage payments. Paying off debt to lower your debt-to-income ratio can help. You can refinance installment loans for lower payments and pay off as much current debt as possible or add another source of income. In most cases, lenders won't include installment debts like car and student loan payments as part of your DTI if you have just a few months left to pay on them. For example, don't make any big purchases on credit cards before you buy a home. If your debt-to-income ratio is exceptionally high, say 50% or more, it probably makes sense to wait on your home purchase until you're able to reduce that debt-to-income ratio. Before you sit down with a lender, use a mortgage calculator to help find a reasonable payment for your budget. The lower your debt-to-income ratio, the safer you are to lenders. But more importantly, the better your finances will be. And if you have any questions, be sure to check with your mortgage professional like me. We can tell you what your DTI is, what loan programs may be available for you, and what steps you can take moving forward. Thanks for watching.